Welcome to another video. If you're new to the channel, I'm a top author on the TradingView platform as well as running an educational program and swing trading full-time with my students. Have you ever wondered which are the best pairs to have on watchlist? Well, in this video, that is exactly the answer that I will be giving you. Let's start by first of all answering the question, and then we will be diving deep on exactly why this is the answer. So the simple answer is you're supposed to be having on watchlist as many pairs as possible. Obviously pairs that you know that your strategy actually performs well on, but the more pairs you have on your watch list, the better it is, and there isn't one pair that is best than the other one. Okay, if your strategy is a good strategy, it will work on 90% if not more of the instruments that you have available to trade on your broker account. So why is this? Why is it that the more pairs you have on watch list, the better it is? Because you can be looking for the best probability setups. If you have many pairs on watch list, the more you have, the more you will be able to be dissecting your watch list and looking at, okay, this pair has many confluences because you're showing the same directional analysis from a monthly, weekly, daily, 4-hour time frame. Okay, you will have all the better confluences if you have a big amount of pairs on watch list. So I will also be diving deep in the charts in this video, showing you how you can do that. Okay, how you can actually be looking for the best probability setups. And we will be reviewing one of my best trades, seeing how I was able to stack as many confluence factors as possible. I will also speak about some more advantages that there are of actually having many pairs on watch list. If you have many, what you will be doing? First of all, you will be able to be more disciplined for the simple fact that you will not be continuously looking for opportunities that sometimes are not there, but you will just see them because you have an itchy finger, right? You want to take the trade. But if there is no opportunity, you can't take it. But if you have many pairs, you will always have at least one that is actually showing a valid entry, a valid opportunity, and you will always find yourself not always sitting on your hands, but actually being able to trade, right? Because you have more instruments and you have higher probabilities of having a setup that is actually following all the rules of your strategy. So I will now go in the charts and show you guys how you can actually find the best confluence for high probability setups. Okay, so let's speak about confluence. Okay, why having a big amount of pairs on watch list will actually help you with your trading to identify the best probability setups and basically having the best risk to reward that you could possibly wish for. As you can see, my watch list is very full. Okay, I have a lot of pairs, and in this way I can dissect it each and every day and basically give to my students only the best probability setups that are satisfying all our rules for entry and are providing the best confluences that there are. So basically I do it for a reason, and let's see, for example, how you can apply this was probably, I got here the best probability setup that I actually ever took, with obviously a huge risk to reward. Okay, so we're talking here about a setup that had all perfect confluences plus a very, very high risk to reward. So I decided this was probably the best example that I could give you for getting a pair that has the best probabilities by having a full watch list. So this is what we had basically on GBP CAD at the time. Okay, we had a market that clearly had created a very nice impulse to the upside, followed by a retracement on the monthly time frame. This means that this was a big move, and after that, what do you expect? Obviously you expect continuation to the upside and the completion of the impulse correction and impulse pattern to the upside. We also had massive, as you know, I like to watch the COT data. Okay, if you don't know what it is, it's basically the positioning of hedge funds in the market. What are they doing? Are they buying? Are they selling? Are they opening more longs? Are they closing more longs? And here we could just see accumulation and accumulation and accumulation. They were buying aggressively the pound and selling the CAD. Just a quick reminder, make sure you comment below and you let me know which pairs or which topics you would like me to cover in the next video. So obviously the push to the upside was very highly probable. Now, taking our Fibonacci from the low to the high of the impulse, and if you don't know how to use the Fibonacci, I made a video about it, you find it there. So basically, what did we have? We had a market that was testing the 0.618 Fibonacci retracement tool, and what did we expect? We expect the next impulse to the upside, right? Specifically because we had a 0.618 lining up perfectly with structure, okay? Because we have here previous resistance, turn support, impulse, correction, and impulse. Everything was pushing to the upside, literally everything, okay? Now, if we go and see what was the situation at the time from a weekly perspective, what did we have? Now, on the weekly time frame, again, we had perfect confluence, okay? Here on the weekly time frame, we clearly had previous resistance, turn support. The market had created a nice impulse, correction. You expect the nice impulse to the upside, which is, by the way, the same impulse that we had from a monthly perspective. Going down on the daily time frame, what did we have? We had a market that clearly was just, it had basically faked out all traders, which is a perfect thing to do if hedge funds want to buy, because if they don't have the liquidity in the market, what do? They generate it, okay? They bring people to actually the wrong side of the market, and then they use their orders to actually fill in their own. So what did they do? They created this nice impulsive move, followed by the retracement, and then two strong red candles to the downside. What most retail traders started to do? They started to sell. Perfect. So they can buy. And at that point, they loaded up proper longs and created this huge impulse to the upside. And at that point, it comes to basically where I actually executed the entry. Now, obviously, when it comes to entry and also direction, there are many rules that I can't share, but I just wanted to, there's one thing that I can share with you here. Okay, this was obviously a very high probability entry as well, because what did we have? Previous resistance to support here, pretty basic concept. You don't need to buy any course to actually know what is a previous resistance to support. And what did you also have? A market that clearly, market makers were clearly hunting all stop losses below this area, because look very closely what had happened here. Impulse, correction, the market started to make the next push to the upside. Everybody is buying, perfect. Their stop loss is here. So we go and hunt their stop loss, and then the push to the upside can start. You want to put your entry where most people are actually putting their stop loss, because that is where you will get the best risk to reward, and that is where basically you will get the best probabilities. And following that, the market obviously made a huge push to the upside. If you're asking yourself why the target was here, okay, why the target to the upside was exactly here, this was a massive 12.8 risk to reward setup. But why the target was actually here? Well, it's pretty simple. If you watch the video about the Fibonacci retracement tool, you know exactly what I'm speaking about, because what do we clearly know? If you have an impulse and you want information on the retracement, you take your Fibonacci on the impulse, as we did on the monthly time frame. But if you want information on the next impulse, okay, so if you want information on the retracement, you take your Fibonacci on the impulse. If you want the information on the next impulse, you take it on the retracement. So taking our Fibonacci from the low to the high of the retracement, we had a clear first target at the minus 272 Fibonacci, and that is exactly where our upside target was, also on the 4-hour time frame. So yes, this is how basically by having a high probability situation where the monthly, weekly, daily, and 4-hour time frame are all showing the same confluences, same direction, you can actually take some pretty massive risk rewards and high probability trades by having a full watch list, because these opportunities, they're not often on a single pair. But if you're monitoring 40 pairs, then definitely you have much more probabilities of having multiple setups each and every week. If you enjoyed the video, make sure you smash the like button and comment below. It really does support the creation of more free education and analysis for all of you, because it obviously helps with the YouTube algorithm. I also suggest you to go and check out the mentorship program. You find the link in the description. It's a very complete program. You first get all the rules of my strategies, and then you trade them live with me. Each and every day you get a new daily market breakdown showing you exactly how you're supposed to be applying the strategies with entry, stop loss, take profit, as well as having me answering every question that you have each and every day. So I'll invite you to go and check it out, or go and check out the next video.